All right, let's jump right into this explainer. Today, we're taking SLB, the company formerly known as Schlumberger, and putting it through the absolute ultimate valuation gauntlet. We're going to strip this energy giant down to its studs and look at it through the eyes of history's greatest investors to figure out, is it a buy, a hold, or a sell in today's market?
Here's our game plan. We'll start with a quick snapshot of SLB, then run it through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll dive into a DCF and some alternative models before wrapping it all up with our synthesis and final verdict.
So, Part 1, the SLB Company Snapshot.
Right now, SLB is trading at $46.99, boasting a massive $70 billion market cap. But hey, if you think this is just your granddad's traditional oil field services company, you really need to take a closer look. They've been aggressively shifting gears toward the future of energy and tech.
This is where it gets super interesting. SLB is making a massive pivot into AI, data centers, and digital operations, and it's completely rewriting their DNA. Just look at the first quarter of 2026. Digital revenue shot up 9%, and their digital annualized recurring revenue officially crossed the $1 billion mark. Wow. Even crazier, their data center solutions segment rocketed up 45%. They're going all in on AI infrastructure, teaming up with NVIDIA to build these specialized AI factories for the energy sector. Throw in the recent ChampionX acquisition, and it's clear. This is a company in massive transition. For us as investors, this isn't just an energy play anymore. It's heavily leaning into tech.
Moving on to Part 2, let's look at this through the Warren Buffett lens.
So what's Buffett's #1 rule? He wants a deep, impenetrable economic moat. And honestly, SLB is digging a pretty massive one. By combining over a century of hardcore oilfield expertise with this exclusive NVIDIA AI hardware and offsite modular data center manufacturing, they are creating crazy high switching costs. I mean, competitors are going to find that combination incredibly tough to replicate.
While we actually crunch the numbers, they check off a lot of Buffett's boxes. He loves manageable debt, right? Well, SLB's debt-to-equity ratio is sitting pretty at just 0.42, very healthy. They've also got incredibly consistent earnings, with a return on equity of 12.38%. And if we're looking for a stand-in for Buffett's famous owner earnings, SLB is throwing off a really solid 6.05% free cash flow yield. So yeah, the business quality is absolutely there.
But here's the million-dollar question. Would the Oracle of Omaha actually pull the trigger at almost $47 a share? Probably not. Even though management is doing a phenomenal job and that moat is definitely widening, this price just doesn't give us the deep margin of safety that Buffett demands. He wants wonderful businesses at fair or discounted prices. Right now, the market is already pricing in a ton of that future AI and digital success.
All right, Part 3, the Peter Lynch lens.
Lynch loved to put companies into specific buckets to predict how they'd behave. Now, historically, an energy services company would be a pure cyclical play. But today, with over $1 billion in recurring digital revenue and a steady 2.51% dividend yield, Lynch would probably call SLB a cyclical that's transforming into a stalwart. Oh, and a quick heads up on the data. Since we don't have the exact institutional ownership numbers, which Lynch usually wanted to see low, we have to assume it sits around the standard large-cap industry average for now.
Now, here is where we hit a massive roadblock in the Lynch framework. Lynch was obsessed with the PEG ratio, which is just the price-to-earnings ratio divided by the growth rate. A PEG of 1 is usually fair value. SLB's PEG ratio right now, it is a sky-high 3.21. Yeah, even with a bulletproof balance sheet, that number screams that the stock price is running way ahead of its actual earnings growth. For a Lynch-style investor, that is a glaring red flag.
Next up, Part 4, the Benjamin Graham lens. Let's get strict. As the father of value investing, Graham had a notoriously strict defensive checklist. Surprisingly, SLB easily passes most of it. Adequate size? Check. They're a $70 billion behemoth. Strong financial condition? Check. Their current ratio is 1.34, meaning plenty of liquidity for short-term bills. They also boast positive net income for earnings stability and a rock-solid dividend record, showing 4 straight years of growth and a current yield of 2.51%. So far, so good.
But Graham was a ruthless mathematician when it came to price. When we back out the inputs from their financial ratios, we get an earnings per share of $2.26 and a book value per share of $17.47. If you plug those numbers into Graham's famous intrinsic value formula, the square root of 22.5 times EPS times book value, you get a brutally low valuation of just $29.80.
At a current price hovering near $47, there is literally zero margin of safety here for a Graham purist.
Moving on to Part 5, DCF and Alternative Models. Let's look at the modern quant side.
So, to build a base case discounted cash flow model, we have to make a few assumptions to fill in the future blanks. I went ahead and used a weighted average cost of capital, or WACC, of 10% to account for the typical macro risks in the energy sector. We paired that with a 5% growth rate for the next 5 years and a 2.5% terminal growth rate. When you discount those cash flows back to today, it points to a fair value per share right around $43. That's definitely closer to the current price, but it still means the stock is fully valued, maybe even a tiny bit overvalued. Basically, at this price, you have almost no room for forecasting errors.
Let's try some other angles. If we run a dividend discount model, it spits out a really low fair value of around $19. Why? Because while the dividend is growing, the base yield just isn't high enough to justify the stock price purely on cash payouts. And if we look at comparable multiples, SLB's enterprise value to EBITDA is currently 10.45 times. Historically speaking, for an energy services company, anytime you cross into double-digit EV to EBITDA territory, you are definitely paying a premium.
Finally, Part 6, Synthesis and Final Verdict. Let's bring this all together.
When we put all of our fair value models side by side, the picture gets crystal clear. We've got the Graham intrinsic value down at roughly $30. The DCF model sits at $43. The dividend model is way down at $19. Every single intrinsic value framework we threw at this stock priced it below its current market price of $46.99.
But investing isn't just a spreadsheet exercise. We have to weigh the qualitative against the quantitative. SLB's strengths are incredibly impressive. A return on invested capital over 60%, that is elite. Their $1 billion+ in digital recurring revenue and the NVIDIA AI expansion are literal game changers. But we can't ignore the risks. The CEO has straight up pointed out geopolitical disruptions in the Middle East as a headwind. Plus, from a valuation standpoint, that PEG ratio of over 3 means you are paying top dollar for that expected growth.
So what's our final verdict for this explainer? It's a hold. Look, SLB is a structurally magnificent business executing a brilliant, totally necessary pivot into digital and AI infrastructure. But right now, it just lacks the margin of safety that Buffett, Lynch, or Graham would demand before buying. If you don't already own it, you might want to wait for a macro pullback closer to that $35 range. That's where the DCF and Graham models actually start offering you some real downside protection. Ultimately, you have to ask yourself one question. In a market that is utterly obsessed with AI infrastructure, are you willing to pay a hefty premium today for SLB's digital tomorrow, or will you demand the margin of safety that built the fortunes of history's greatest investors?